Hello, everybody. Welcome back to the series of annual report analysis. Today, we are analyzing and doing quick DCF valuation of Indian auto stocks. So, we'll be looking at Eicher, Hero Motors, Bajaj Auto, TVS scooters in the two-wheeler segment, then Escorts, Tata Motors, Maruti Suzuki, Mahindra and Ashok-Leyland for the four-wheelers and your commercial vehicles and reference their respective annual reports. And just to start with a little disclaimer, the content of this video is for educational purpose only. If you decide to use it for making any investment decision, then you're doing at your own risk. Okay, so let's start with, first I want to introduce you to the little Excel sheet I keep for doing a quick valuation. So what happens is I do this for all the stocks that I follow. This gives me a rough idea of the valuation. So not the final valuation that, if I just give some high level numbers, what the fair value looks like. Now, if the stock price is way above the fair value, I don't even bother doing extra analysis. But if the stock price is actually below the fair value, then I start looking further, like, hey, is there an opportunity to invest there? So just want to showcase you how I create this. So let's look at the Eicher motors first. So there are different columns here. I'll explain you. So obviously the column where you see as green, the value is derived. That means it's derived by a formula. And the column that is not green, there I have to input. So obviously it starts with how many shares are outstanding. So you can get it from the annual report or anywhere, and you put it as 2.72 crores. Then what's the total assets, of the company? It's about 9,500 crores. So, and then assets minus liability is the book value. Then I put the book value, and obviously asset minus book value is the liability you get. Then I do there is a assets divided by liability, you get the ratio. Now this is a very high level. It tells you what's the leverage. So here you can see, like, Bajaj Auto is the least leveraged company. That means they are, like, so the less the leverage, that means the less is the risk. So this is a different concept I'll explain, but just keep that in mind. Then once you have that, you I get the net property and operating leases, that is about 1600 crores for Eicher. Then the goodwill intangibles, so all this I subtract from the book value. Then then there is the sales, the base value of the sales figure I take for the last year of 9500 crores. Then what is the effective pre-tax margin? So this is before depreciation and amortization. So that I multiply by this, and then I get the pre-tax cash flow. So that's the first important figure that one needs to figure out. Then if you multiply that with the tax rate, you get the operating cash flow. Okay. So then so that's around 2195. Now from there I have to subtract what is the capital investment needs. Okay. So this is the cash they need to put in for building new factories and upgrading. So if you subtract this minus this, you get the free cash flow. That means that's the cash the business is generating. Then what I do is I put in a rough growth estimate. Okay, this is like very straightforward. I just take 8%. Now, obviously, each company is going to grow, like Eicher Motors, especially. It has grown a lot in past few years, right? I mean, its market share was somewhat around 3% in its that about 350cc category, and now it's 27%. So, but I still keep it 8%. I'll explain you, because that way, if you keep a conservative estimate and you do a quick valuation, and let's say even then the fair value is more than the stock, that means there is so when you do the real valuation, and obviously when you do the put on some factor of safety, there is a chance that the fair value will be more attractive. So but it's just like, let's say I'll want to estimate you like, you are trying to estimate how much money you're going to earn in your life. Very simple, right? So let's say you have a job now, and you earn, let's say someone earns $100,000. So obviously, they might get a great promotion, next year, things like that. But if you want a conservative estimate, you'll think, you know what, he's just going to get 5% increment every year till he retires, and you figure out that amount. So that's a conservative estimate, right? So that's why you start with a conservative estimate and then you make adjustments. So that's how you actually value a business. It's like a, different steps you take. So the first step is taking a conservative approach, and then obviously the discount rate. So that's the rate of the risk free rate plus the risk premium that you have for the business. And then the growth rate beyond 10 years. So that's, I've just put 5%, just below the inflation rate of India. So when you put that, you get like, 10-year aggregated discounted cash flow and terminals. You like how I get that. So I have a calculator here. So let's say I put in 1995, right? So I put in this value here. So this is for Eicher. This is the free cash flow 1995. So this is all been formulas I have created. So let me put it like this. I hope you can see now. And so if I put 1995 here, so see, it gets me 18,394, 29,993. So this is the growth rate for 8%, discount rate 10%, the rate after 10 years 5%. So if I do that, I get this. Let us go back here. See, that's the value I have put in here, 18,394, 29,993. Then if you now let's come back here. So when I add these two values, so the sum of column Y and column AA, okay, if you do that, you get the equity fair value. So that's basically the 10-year discounted cash flow plus the terminal value. Okay, that's the quick valuation for discounted cash flow method. And then that you divide it by the number of shares outstanding, you get the fair value. So it's a fair value is around 20,000 rupees for Eicher Motors, and its share price is around that. So it's kind of share price is almost same as the fair value. Now, let's say we do this exercise for everyone. So this is the result. It's kind of interesting. So you see the Hero Motors fair value is about 94,000 crores market cap, and so shares per share value becomes 4,700. But it's like this is around January 9th. It is around 3,000 rupees, 2,937. Then Bajaj out of 4,000 is, so these two are really undervalued stocks. Then another two undervalued are Mahindra and Ashok-Leyland. So here also you see it was 1143 and stock was at 726, and Ashok-Leyland is 139, stock is 495. So now we have so out of nine we have figured out, okay, four are like that. So now let me come back for this now. For Tata Motors, you might ask, hey, why I don't see a value? Because Tata Motors is anyone even who is thinking of investing Tata Motors should look at this figure and should really think about why he has to do it, because their free cash flow is negative 14,000 crores. That means they are burning cash. So that let's say the amount of cash they are getting, and the like if you subtract the operating cash flow they got was 19,500. Now the capital in expenditures and other reinvestments was 34,000 crores. So 19,000 minus 34,000 is almost about 14,464 crores. So that is, so Tata Motors is really cash strained. Now, obviously, you can take a like you can speculate on it. So again, one needs to remember the difference between investment and speculation and think, oh, you know what, they're going to turn around and all. But right now, let's keep those kind of case studies aside. We're looking at very simple investment like opportunities where the company is producing good cash flow, and there is a like a good factor of safety. So now, out of those, so we have come down to Hero Motors, Bajaj Auto, Mahindra, and Ashok-Leyland. Now, here let's look at who's has the best assets to liability. So Hero Motors has 3.22. Now Hero Motors also has something called Hero Finance, which they value by equity method accounting. That means actually this will go down if they bring those into balance sheet, but that's off balance sheet accounting. So it is actually way below by 3.2. Bajaj Auto is 7, and Mahindra is 1.49, and Ashok is 1.33. So obviously, if you look here, out of all, Bajaj Auto is the least risky, and it is really undervalued. Its share price is around 2,700 or something like that, and its fair value is about 4,000 rupees. Now again, this is just a quick valuation. Obviously, when you go inside and do some more analysis, so that there is good factor of safety. So let's say the factor of safety is 30%. Let's say I overvalued it by 30%. So 4,000, even if you take 70% of it, it is still like uh, about 2,800. So about 3,000, you can say. So even if that's what I'm saying. So even if you're like really the downside risk, if you're looking at it, it's really very less. So all you can get is the upside. And the second thing is, when you're investing in Bajaj Auto, another very important point I want to tell you is, you are not just betting on the two-wheeler business, you're also betting on its three-wheeler commercial business, which is kind of stable, and they are the leader there. So you're kind of getting, you see, like a little bit diversified. So you're not just exposed to one. So you're, which is, I would like that kind of a bet more. So again, this is just let you know, this for educational purpose only. I would highly recommend you to do your own research a little bit more before you decide. But just based on these figures, Bajaj Auto seems to be the winner amongst all other stocks. So please, if you have any questions, please get back to me. This is my email ID here, dn_minashi@yahoo.com. I would be happy to answer any your questions, and we and hopefully you will be able to help you make your investment decision. Thank you.